Well, let's get across the market open now. Zach Riaz joining us from Banyan Tree Investment Management. Zach, welcome to Tuesday. Good to see you. Big day ahead, of course, with the RBA. We'll get to that in just a moment. What do we see on Wall Street? There was a lot of focus there, particularly in the wake of that Moody's downgrade of the US credit rating.
100%. That's been the talk of the town. It came in on late Friday. Look, a lot has already been said. I think yields have basically moved back to their original positions. They recovered some of the losses they were experiencing overnight. Look, at the end of the day, I'm not sure why Moody's decided to go now, but I think it was largely a catch-up. Fitch.
Well, they're late to the party, aren't they?
Yeah, absolutely. So S&P 500 2011, Fitch went into 2023. But one thing I will say, both those prior downgrades were on the back of some quantifiable issues. So obviously 2011 was the first time debt ceiling issues rose. And then 2023, it was Yellen issuing $1.7 trillion in debt. There was something very specific. But if you look at, I guess, the US debt levels, they've been pretty much stable this year. And I think it's just catch up. But at the end of the day, the real implication, well, the question for the markets is, will people run away from US Treasuries, US debt? This chart shows you actual total US Treasury holdings by foreigners has actually continued to climb. And the most recent major buyers were Norway and UK. So look, there's no change there. The other thing that investors need to be mindful of, the first time the downgrade happened, Andrew, there were caveats around collateral for hedge funds of what kind of level of securities they could hold. Since that time, a lot of those hedge funds and institutions have changed their mandates to ensure any downgrades doesn't impact them. So overall, much ado about nothing, and very much late to the party, I would say, for Moody's.
Yeah, but no, they may be sort of getting ahead of what is coming, certainly as far as Donald Trump's big, beautiful bill that he's trying to get through Congress at the moment, with that focus on tax cuts, adding to that debt position of some 36 trillion US dollars.
Well, this is the point. Why wait not until you have all the details there and what gets passed through? That's the other question that people are asking, right?
Yeah.
You know it's coming. You know the tax cuts are coming. You know the cost savings are coming. So why not just wait until all of that, we get clarity on all of that, then make that decision? Which again, I don't know. Look, the skeptics in the various corners will tell you it was slightly politically motivated. Who knows what? But to your point, I think if that is the argument, then they could have waited a few more months to get a bit more clarity.
So what was the response on Wall Street, in particular, as far as equities were concerned? We did see those bond yields initially move higher.
Yeah, so I watched the bond yields. Both credit spreads initially widened. They've come back down. Bond yields have come back down as well. Equity markets have largely taken in their stride. And look, I think this is now, since 2011, a recurring issue. The debt ceiling impasse will come in July. Again, I know there'll be toing and froing, but eventually they will raise the debt ceiling. And I think it will be, again, just business as usual. So in terms of actual market movements, everything's just pretty much going back to the pre-announcement from what I'm seeing.
Yeah, while we continue to ruminate, I guess, in relation to trade and tariffs, but we do have, well, less than 3 months now, but nonetheless, we'll see what Donald Trump manages to hammer out. Zach, let's focus on the local market then. Of course, the big event today is the RBA decision, expectations that they will be cutting again.
Yes, and look, I would not be surprised if they don't cut. And this is also the tone of the upcoming FOMC meeting as well. I think there is, obviously the market is 100%. I think the market is saying it will be 100% baked in. There's nothing wrong with the US with the RBA going as a insurance cut. Inflation is back within their target. I think it's been there for the last 6 months. So I think you'll get your rate cut. But just in terms of the individual sectors and the market movements, I would suggest that if you look at the REIT sector, if you look at the bank sector, look at some of the rate sensitive sectors, they've already moved ahead of this decision, which a lot of people are saying is 100% bankable. But I would caution investors when you look at it across different sectors, when you look at how this plays out in P&Ls and in demand, I think there are various lags, and you may see discrepancies on how it actually plays out in demand and P&Ls, which invariably leads to how share prices react. Let me give you one example. For the banks, the rate cut will initially show up in the net interest margin within your 3 to 4 months. But in terms of demand and how how improves that volume growth around mortgages, that could be 1 to 2 years. So just got to be careful.
Well, goodness, if they don't deliver a rate cut, what's the market response likely to be?
I think it will be adverse. Yeah, 100%. I think you should be prepared that they may cut, but they may deliver a hawkish
cut. Which sounds...
I'm not going to back myself in the corner here. So, hawkish.
Well, we'll obviously find out today. In fact, you're going to be joining us later for some reaction to that too. So I look forward to that. Now, let's get into some stock ideas. Well, specifically, you're focusing on Monash IVF. Now, this has been in trouble.
Yes.
Reputational damage there. There was a mix-up that they had. It's been a bit of a mess for them, in fact, and we've seen that reflected in the share price. Certainly more recently, which has come off dramatically.
Yeah, it is a very serious mix-up. It's very important to understand that Monash IV is a very niche business, is a very specialist business. What they did, mixing up the embryo, which led to the birth of a child with the wrong patient, that's very serious. But you need to keep in perspective, these guys do thousands and thousands of it. It was human error. But I think from a reputational point of perspective, I want to just put your attention back to when Medibank Private had the data breach. I'm not saying it's a like for like, but all I'm suggesting is that if earnings don't get impacted, it is difficult to quantify what the reputational damage is, but be mindful that this is a very specialty area. You can't go to the next corner shop and get your embryos all done. So at 10 times PE, EV/EBITDA of 5.2 times, just keep in mind, this is a sector that is no stranger to M&A, especially for private equity. I think this is the last well-known listed IVF company. And so difficult to quantify, but Medibank Private took about 6 months for its share price to recover. I think if reputation damage is largely maintained, even though it's difficult to quantify right now, this is a company that definitely has a valuation of between $1.10 to $1.50. I know it's a wide range, but I'm telling you, this is not worth 85 cents and where it is today. So it is a very deep contrarian play, but the risk reward where it is today looks very attractive to us.